Thank you all for giving me this opportunity to speak to you about some of the topics that are of great interest to myself. The topic of digital money, and let's face it, money in general is often not the easiest thing to talk about, especially for people who haven't had a lot of background in economics or certainly in monetary theory. So this is a difficult subject, but I'm going to try to make it not so difficult. And I don't mind if you want to interrupt me with a question now and then for clarification, and then we'll have time at the end for general questions. So the thing I want to talk about today is the possibility of completely private money. That is, the possibility of living in a world where anytime you pay for anything, you're not relying on any government agency or any central bank for the media that you use. At least you're not relying directly on any government institution. Right now, you rely, to some extent at least, on government-provided money, the notes of your central bank, the paper currency or plastic currency, as it were, that you're using. And my main concern is to talk about the possibilities of completely privatized money. Now, the reason this subject is controversial is that for practically all of history, it has been taken for granted by people that the government must be a supplier of at least some sorts of money that are in use in their economies. This goes back to very ancient times when governments monopolized the production of coins, especially gold and silver coins. And so it began to be taken for granted that they alone were capable of producing such things, and no one else could be trusted to do so. And of course, the governments themselves assiduously promoted this belief. Later, they promoted the same belief about circulating currency, paper currency, that issued originally, as we'll see, by ordinary private banks, but eventually monopolized by governments, much as coining money had been monopolized by them in the past. And today we see the emergence of various digital substitutes for official currency. And once again, we see the central banks of the world, that is the governments of the world, talking about monopolizing digital currency, as they call it. So what I want to do is say, well, what's the alternative? Can all of these things be, in fact, provided, not only provided, but safely provided by private institutions so that we don't have to rely on government? And would we be better off if we didn't rely on government to supply all our money? Now, the first thing I want to note is that mostly I want to talk about currency. There are two basic kinds of money that people use today and have used for a long, long time. There's the kind of money that requires that you have an account at some kind of financial institution, usually a bank. And that consists of the deposits you have at a bank that you can transfer with your debit card in making a payment, or by writing a check. We still do that sometimes. Maybe most of you don't, but I certainly can remember writing checks. So that money I'm going to just refer to as deposit money, although it can also take some other forms. The other kind of money that tends to be used less and less is circulating money. That includes today the coins that you use. You still use some coins, and the paper currency or plastic bills issued nowadays in most places by central banks. Most of the money people use today is deposit money, and that's already private. That's privately supplied because the banks that supply it are usually ordinary private commercial banks. They're regulated, but they're still private institutions. So that kind of money has for a long time been mostly privately supplied. Circulating currency, the other kind, That's the stuff that governments have long monopolized. And so it's more interesting to focus on whether that can also be privately supplied. And if it were, would that be a bad thing? Which is what governments have been telling us is the case for centuries. Well, if we go back into the past, we don't have to go that far. Well, it's further for you than for me, but we don't have to go that far to find the times when when currencies have occasionally, and sometimes often in the past, been privately supplied. So the first thing we should ask is, what does the historical experience with private currencies tell us? How common was it? And how well did it work when it was allowed? A lot of you may not realize, and many economists seem not to realize, that the modern arrangements where most countries have central banks that have monopolies of currency, and they have government mints that are the only institutions that produce their coins. Well, the mints have been around for a while, but central banking is mostly a 20th century development. There were a few dozen central banks in the world before the 20th century, but most of the ones that exist today came afterwards. So it's a pretty modern development. So what was true before? What was true of countries when they didn't have central banks? The answer is that ordinary commercial banks, the same kinds of banks that you have deposits at today, they used to supply paper currency, circulating paper money, instead of any government-sponsored bank in most places. So, for example, you could, if you lived in Canada, which was a very interesting example for a number of reasons, until the 1930s, the paper money in your wallet would come not just from one, but might come from several different private banks. There were, at different times, anything from a dozen to 40 or 45 different banks that issued paper money in Canada. And you would see the note, and it would say the Bank of Halifax or the Mercantile Bank. It would have the name of the bank that it came from. They were all based on the same basic money, like the Canadian gold dollar, such as it was at the time. Just as today, deposits in different banks, you know where they are. They're at different banks, but you also know that they're all uniform and relate to the same fundamental, basic underlying currency unit. What's interesting, much more interesting than the fact that once upon a time, many private institutions supplied their nations with paper currencies, is that in at least some of these cases, they did a very good job at it. Their currencies were totally reliable, totally uniform. There was no difficulty dealing with them. There were cases where there were severe problems. But here's another interesting fact, and I'll supply some examples in a moment. Some of the least regulated of these private currency systems of the past were also among the ones that were the most successful and the most stable, the most efficient. That statement might sound paradoxical. How can it be that with less regulation, you had some of the best private currencies? In Scotland, for example. Scotland's currencies, today still, by the way, if you go to Scotland, the currency that they use is still issued by private commercial banks. It's one of the few remaining exceptions. Now they're heavily regulated. That wasn't so in the past. But back in the past, there were many more issuers of private currency in Scotland, and the reputation of its banking system was, I think, greater than of any other banking system in the world at the time. Famous for avoiding crises, for being stable, for having many innovations that now we take for granted in banking, for being efficient institutions that contributed, by the way, a great deal to Scotland's economic development. Scotland was a very poor country in 1700, very poor, much poorer than England. By 1800, it had caught up. And according to Adam Smith, who writes eloquently about this, one of the main reasons was its highly efficient, productive banking system that made very good use of people's savings to foster economic development in Scotland. Anyway, that's one of the success stories. There have been many others. Canada, I mentioned. The Canadian banking system was the envy of citizens in the United States for the last half of the 19th century and the first decades of the 20th. The United States had crisis after crisis after crisis. And in Canada, nothing. Everything was fine. But it wasn't because they had a central bank that took care of everything. They had a competitive currency system with a few dozen banks supplying the currency. And that currency was uniform. You could take a banknote from the Bank of Halifax and you could go to Vancouver. It commanded its full value over there as well, mainly because the banks were branched everywhere in the country. So what was happening in the United States at this time? There was crisis after crisis after crisis. Why? Because the banks weren't regulated enough? No, it's because we had really stupid regulations. People sometimes tend to assume that regulations make things better. But at least in banking history, you'd be amazed at how many regulations in the past destabilized banking systems. You may wonder why they would have such regulations, but it usually was because they were either catering to special interests in the banking industry. Many regulations are shaped by industry insiders, lobbied for or otherwise influenced, and because some of the regulations served the government's narrow interests, like helping the government raise money. So in the United States, you had all kinds of regulations. I'll just mention two. One regulation, this is before the creation of the Federal Reserve. This is in the decades leading up to that event. The Fed was, of course, created to address the financial crises that were afflicting the United States. One of the regulations that was common was that banks usually could only have one office. They couldn't branch at all, which made most of them very small and financially under-diversified, so it didn't take much for these banks to fail. Another regulation was the fact that banks, many of them, the national banks so-called, were required to invest a big chunk of their portfolios in US government securities. Now, you might think those would be pretty safe. And at this time they were, except the government was reducing its debt and was retiring it. And so what happened in the course of the late 19th century is the banks couldn't get a hold of enough of these securities to meet the requirements of the law. And so the quantity of banknote currency, of paper currency, shrank while the nation was trying to grow. And shortages of currency resulted that were one of the main causes of those frequent crises. In fact, the Federal Reserve was created to supply an elastic currency because the old system couldn't. But if you looked at Canada, with no regulations to speak of, the supply of currency was totally elastic, and you could guess how it behaved by knowing how the demand for currency would tend to fluctuate seasonally and over time. It would go up, the supply would go up every harvest, and it would grow secularly because the economy was growing. And you would look at this pattern of currency supply in Canada and say, oh, they must have a very, very alert, successful central bank. But they didn't. The United States also didn't have a central bank, but didn't have a well-regulated banking system because there were too many stupid regulations. Okay, what I'm trying to say here is all about history, but it's important as background. And what it is that you could have had with old-fashioned technology of paper money, you could have a private paper currency and therefore a completely privatized money supply with very little regulation, that could be very, very successful, very stable, very efficient. I haven't said anything about coins, but I want to talk about them as well. Although it was once upon a time common for ordinary banks to supply paper money, what has never been common in history is private provision of coins, of actual metallic coins. Governments have very jealously preserved or protected their monopolies of coins since ancient times. By the way, why did they want these monopolies? And why do they want monopolies of currency? Monopolies make profits. They make monopoly profits. So with coinage and currency, they make a special kind of profit called seigniorage. And it's a very useful profit for governments to have access to, because all they have to do is issue more money and they can fill their coffers. The main motivation for governments monopolizing currencies of different kinds, paper or coins in the past, was this seigniorage motive. It wasn't making the public better off. And they would often abuse their powers of creating currency and coin in ways that made it clear that the public welfare was not exactly the thing that was motivating the existence of those monopolies. If it had been, they would have been managed in the public interest. Anyway, there have been episodes in the past where even coins have been privately supplied. I'll give you some examples. Because what we want to know is, okay, what happens if we let the private sector do what normally governments alone do? Is it a disaster, as the governments tell us, or not? Well, in the few instances we know about, it wasn't a disaster at all. In fact, the private sector did a better job producing coins than governments did. By the way, a coin producing business is called a mint. But it's just a factory that takes metal and turns it into units of specific design and weight and fineness of metal. So it shouldn't really be counterintuitive that a competitive industry would do a better job than a monopoly, though most economists don't seem to have that intuition. But let's ask about the facts. In, for example, the California gold rush, at that time, there were only two official mints in the whole United States. One was in South Carolina, one was in, well, there were three, pardon me. There was one in South Carolina that was relatively new. There was one in Philadelphia, and then there was one in Washington. The miners, of course, were taking all this raw gold out of the ground, gold dust, gold nuggets, and they needed to turn it into coins. It was very costly and time-consuming and risky to send all that gold to one of those eastern U.S. mints to get it converted into coin and then have it sent back. So, in the absence of any local official institutions, private mints, a whole private minting industry grew around San Francisco. And they minted private coins. They didn't copy government coins, they were distinct. Numismatists, that is, people who study coins, have looked at these coins. And what they found is, because of competition, there were some mints whose products were not very good. They were not up to the standard of the official mints. But then there were others that were at least as good or better, and those were the ones that prospered and ultimately survived. Just as you would expect, when people had a choice of which mints to go to with their metal, they would patronize the ones that had a reputation for making coins that were what they were supposed to be. So the evidence, and I could give you other examples, but the evidence about private coinage shows that when it has existed, competitive coinage now, the thing that's crucial isn't private versus public or nationalized versus privatized. It's competitive versus not competitive. It's competition that encourages good quality. Okay, all of that's about the past. Now, of course, the creation of central banks and governments clamping down on private coinage, which they all ended up doing, meant that, for better or for worse, until recently, currency has once again been something completely monopolized by governments. But the advent of digital currencies, particularly of crypto, and especially in the form of stablecoins, is now challenging governments' currency monopolies all over again. So now the question is, could these modern digital private currencies also be as good or better than the stuff governments have been supplying us with? And as I mentioned before, governments, of course, are aware of these new innovations, and so they have the possibility of reacting to them either positively or negatively. They could clamp down, and some have, and make sure stablecoins, for example, never really gain a foothold in the system. Or they could encourage these private substitutes. Finally, they can try to compete directly with stablecoins, and that's what many central banks are thinking of doing if they haven't already started, by issuing their own central bank digital currencies, which are meant, among other things, to preclude the advent of private digital alternatives. So they can outlaw those alternatives altogether, they can hamper them by tough regulations, or they can try to crowd them out with their own digital currencies. A lot of times when you hear criticisms, and most economists are going to tell you, oh, we can't have these private digital currencies take over. That would be a terrible thing. Most economists are saying that. I think they're wrong for all sorts of reasons. I'd like to take the last part of my talk, the last 20 minutes, to explain to you why the arguments that are being made against privatization of currency through digital alternatives are not sound. One of the most common arguments refers to the history I referred to, except it gets the history all wrong. And this is a very common argument. They'll say, oh, in the past, when we had private paper currencies, it was a disaster. And they will point to usually only one episode, which is before the Civil War in the United States. Private banks were issuing currency with state charters because there was no central bank. And in many of the states where this was happening, with so-called free banking laws, the currencies were not very good. Now, first of all, they exaggerate the number of bad results. There were about a dozen states that allowed free banking, as they called it, during this period from 1837 to the Civil War outbreak. And some of those systems actually had pretty good records, but a few had terrible ones. And one in particular, which was one of the earliest, the free banking system of the state of Michigan, was disastrous, had disastrous consequences, and actually was, in a few years, had to be completely abandoned. What they'll point out, these economists, is they'll point to this really one case. They don't say that it's only one case, but they'll say, oh, in the United States, what they mean in Michigan for 3 years. You had a lot of bank failures, and the notes of those banks, and this was also true of the other systems, the notes would not command the value they were supposed to command in terms of silver or gold or whatever was the prevailing standard unit at the time. They depreciated. And they depreciated more if you went far away from the bank than when you were close to the bank, when they might still be worth their nominal full value. What they don't tell you, besides the fact that this was the biggest problems were concentrated in one or two states, is that the bad consequences of the bad private currencies were bad entirely or almost entirely because of stupid American regulations. For example, in those free banking systems and many others in the US at the time, as I mentioned was true later as well, none of the banks were allowed to have any branches. So what that meant was that was the simplest reason why if you took a note from one of these free banks and you went far away from the bank, the note would depreciate because somebody had to bear the cost of bringing it back to that bank to get gold or silver or whatever it was worth. And that cost would be taken out of the value of the note. The reason why Canada didn't have that is because the banks had branches. So if I took a note from the Bank of Halifax to Vancouver, there would be a branch of the Bank of Halifax there. And so I could redeem the note in gold or silver without having to ship it back to Halifax. Whereas if I took a Michigan banknote circa 1839 out of the state, the only way I could get it paid in gold was to ship it back to the bank, which could often be very difficult. The other reason so many of these so-called free banks failed in Michigan and a couple other places because the governments told the banks they had to invest in certain securities. They were forced to buy certain securities by law. And the biggest cause of failures was the fact that many of the securities the government made them buy, the bonds, were turned into junk. So they lost money and they failed. But it was because of regulation. It wasn't because of its absence. When you look at the least regulated systems like Canada and Scotland, you see the most successful private currencies and better than those of official, with better records as many official currencies. Okay, so that's one of the arguments that people make, economists make, against letting private digital currencies proliferate and take the place, potentially, of government stuff. The other argument you hear basically boils down to this. Oh, look at some of these stablecoin issuers that we already have. Many of them have had bad records. Some of them have failed spectacularly. And even those that haven't failed, their currencies don't replicate the currencies they're supposed to replicate. They're not really, truly 100% stable. Most stable coins are dollar denominated. So lack of stability means that a $1 stable coin isn't always worth exactly $1. But here again, the reason why this is true is because these governments have not allowed stablecoin issuers to enter into the ordinary banking business. They've pushed them into a sort of gray market. They're not allowed to participate with other banks in the rest of the U.S. payment system. I'll tell you more specifically what I mean in a moment, but first I want to give you an analogy. Suppose I have to be careful what example I give, but in general, I think you know, when you make something illegal, you create a black market for it, and then the quality of the stuff tends to deteriorate. A famous example of this was the United States in the 1920s during Prohibition, when we made alcoholic spirits illegal. That didn't do away with alcoholic spirits at all. That was the idea. Instead, people drank as much as ever, but they were drinking illegally from black market, consuming black market illegal liquor, a lot of which was of very poor quality and some of which would kill you. Now, if you had never heard of what the alcohol industry looks like when it hasn't gone through Prohibition, if all you knew about having alcohol available was what you gathered by looking at what things were like in the 1920s, you would say, oh God, it's a good thing we have these laws, because look at how terrible it is when there are these illicit suppliers of alcohol. We should try harder to ban them all. In fact, though, if you don't ban them at all, you get, well, what we have today. Alcohol is still dangerous, but it's probably not poison. And after all, it hasn't turned out to be a greater social problem than it was during Prohibition. It's the same thing with private money. If you put enough barriers in the way of the legitimate creation of private currencies and send them, as it were, underground or overseas as, for example, is the case with many of the big stablecoin providers, Tether is not a U.S. institution. It has to operate outside of U.S. borders. You're going to get stablecoins that are not the best that they could be, because it's not quite a black market, but it's already a gray market. Now I want to just be specific, and then I'll wrap things up. What is it specifically that the U.S. government, for example, needs to do to allow stablecoins to be as good as they could be and really achieve what I think is their potential to be the currency of choice that replaces any kind of government currency, that will make ordinary coins unnecessary in the U.S., that will make it unnecessary for anyone to hold Federal Reserve notes in their wallets. Ordinary wallets will go away. Electronic wallets will be enough. You could even give money to a beggar electronically if he has a wallet of some kind. What is it going to take? Well, the main thing it's going to take is allowing stablecoin issuers to take part in what's called the clearing US dollar clearing and settlement system. And to explain the significance of that, I have to go back to history. Let's take the Scottish banking system. As I said, it was highly efficient. Banks got by with very slim reserves of gold or silver. The banknotes were really trusted. They commanded their official gold or silver values anywhere in Scotland. Occasionally, a Scottish bank did fail, but for the most part, the system was quite robust. But what made it so good? Competition. But one specific kind of competition was extremely important for the self-regulation of the Scottish system and other free banking systems. I'm sorry, I'm walking away from the mic. Can you hear me just as well?
Yes.
My voice is usually adequate. The competition that mattered most was the competition among all the banks. They're competing with each other. How are they doing that? Every time a bank would get hold of some of the IOUs of another bank, whether it was paper notes from the bank or checks or other items, they would send them through a clearing and collection system, and that would result in the bank having to pay up for those items. Yes?
Sorry, they cannot get you in the...
Oh, they can?
Yeah, sorry.
I'm sorry. So the banks were constantly putting pressure on each other by sending notes and other items back through a clearing and settlement system, whereby very quickly a bank that issued a lot of notes would get them back. They'd have to pay the bank that sent them, unless they had as many notes from it. And this was all very efficient, and it kept the banks honest, because they were always tested. And if they didn't keep enough reserves or otherwise were mismanaged, they were going to fail. Now, the same checks and balances, the same kind of clearing disciplines modern banks as far as their deposits are concerned. If you use your debit card and you pay somebody, the bank that the payee deals with is going to have an item to collect electronically now from the bank that you use. And that's going to be cleared, which means that the electronic signal is going to be received and sent to the other bank very, very quickly, and the other bank has to pay up. If stablecoins are going to be safe and efficient, they need to be allowed to take part in the same clearing and settlement arrangement, so that if you make a payment with a stablecoin, the stablecoin issuer is going to have to make good on it with real dollars, for example, in the United States, just as your bank has to make good on a check that's presented to it with real dollars that it pays to the other bank. But right now, no stablecoin issuers are allowed to take part in that mechanism. To do so, because the Federal Reserve doesn't have to, but the Federal Reserve runs our clearing system. It's all done on the books of the Federal Reserve Bank, debiting this bank, crediting that bank. So in order for any institution to take part in the dollar payment settlement system, it has to have an account at the Fed called a master account. All banks have master accounts of the Fed. They couldn't function. They couldn't really be participating in the US dollar payment system if they didn't. So it's absolutely crucial for them to have these master accounts. If a bank didn't, it couldn't clear and settle, and its money wouldn't be as good. Its deposits wouldn't be as reliable, and that would be that. But stablecoin issuers have not been given Fed accounts. They've applied, but so far the Fed has refused to admit any of them. And until it does, we can't see how well these stablecoins could work and how capable they are of being more convenient and more safe than any alternative. Of course, they would be more convenient than the paper money that the Federal Reserve issues. That's pretty inconvenient to deal with. They'd be more inconvenient than metallic coins, but they would hold their value usually just as well, to judge by the experience from other kinds of private monies in the past. But we have to let them in. They will not ever be very good if we don't. And that means the regulatory authorities have to open the door to allow them into the system that other kinds of private money make use of in order to be as reliable as they are. So there are, of course, problems with this proposal or this idea. And the biggest one is resistance from the established banks. Most banks are not issuing or trying to issue stablecoins. This might change. Instead, other kinds of financial institutions called fintechs, separate from banks, are the ones that have moved into this area. They're the big innovators. The banks don't want the fintechs to be able to have master accounts because they say it's not fair because the fintechs aren't subject to the same regulations. This is not a bogus criticism, but since the business model of most of these stablecoin issuers is completely different from that of banks, it wouldn't be fair to subject them to the same regulations. One very simple difference, obvious difference: banks make loans, and lending is risky. Stablecoin issuers, for the most part, don't make any loans. The only investments they make are usually securities or cash that they hold to back their stablecoins. So one compromise I've suggested is, look, the Fed should give a master account to any stablecoin issuer that backs its stablecoins 100% with Federal Reserve dollars. That's a pretty radical restriction. That's not free banking. But it's a good compromise to allow the process to allow the stablecoin industry to prosper and mature without having any obvious advantages over the banking industry. And then if banks want to issue stablecoins, they would have that right too, so they can't really complain. And they would be subject then too to special regulation for their stablecoin liabilities. You also wouldn't have to insure stablecoin issuers if they have 100% reserves. 100% reserves is an alternative to insurance because there's no risk. So if the path I see towards a completely private system, which I think would be a very good system, is this compromise where you open provide master accounts for stablecoin issuers, let them take part in the same clearing and settlement system that banks take part in, with the Fed overseeing the whole thing, apply the simple regulation of 100% stablecoin backing in reserves, and otherwise leave them unregulated, because that's one very solid regulation that should be able to handle anything, and see how the system develops from there. And don't issue central bank digital currencies until you can establish that these private alternatives are somehow deficient. And there's a special reason for saying that last part. Governments don't compete fairly They use all kinds of implicit subsidies and take advantage of all kinds of special arrangements to outcompete private sector suppliers of stuff when they do compete with them at all. The most obvious way in which government competition is unfair is, well, how often do governments fail when they compete? The answer is they don't. If the Federal Reserve's digital currency turned out to be highly uneconomical so that it wasn't earning a positive return, do you think that the Fed would have to stop? Do you think that the Fed would give up? Of course, if the private supplier isn't able to recoup its costs, it fails. Now, that's a very powerful reason right there for not letting the government compete with private suppliers, certainly in the money business, probably anywhere, even until you know that the private suppliers really can't do a decent job. But there's another reason, and I'm going to conclude with this. Governments like to snoop on their people and can abuse their powers of currency issue in all kinds of ways. In the past, they abused those powers to gather seigniorage revenues, even if it meant debasing the coinage or inflating at high rates. But here we have another kind of abuse that in some ways is even scarier, another potential abuse, which is the ability to observe every payment that everybody makes, and even to program the government's digital currency to prevent people from buying certain things, or to allow the government to suddenly confiscate some of people's money holdings. They can't grab the Federal Reserve note from your wallet in the United States. They can grab central bank digital currency from you if they so choose to punish you. So for all these reasons, I think we should allow private digital currency a chance, and I think we should resist the government trying to do what the private sector might be very capable of doing and doing better than the government. And that's my spiel. And I hope that you all understood most of what I said, but I'm happy to answer questions about it. And I haven't said anything about Bitcoin. Let me give you 5 minutes for Bitcoin. Bitcoin is an amazing innovation. I was involved with it very early, very sympathetic to it. But Bitcoin is different from all the things we've been talking about because it's an independent monetary standard. That is, it would replace, if it could, the dollar or other national currency units, not as a close substitute, but as a completely different currency unit. Now, that's quite ambitious. Unfortunately, up to this point, Bitcoin hasn't succeeded in really challenging any official monies. And there are two big reasons for that. One is it's really hard to get a new currency unit going because currency is a network good, which means that it's easiest for everybody to use the currency everybody else is using in any given economy. So it's hard for anybody to switch their medium of exchange, unilaterally without others going along. Instead, famously, Bitcoin has become a great investment asset with a very high rate of return, at least in the long run. But that too is prejudicial for its becoming a popular substitute for money at national monies, because it means that the tendencies for people to hold or hodl Bitcoin, well, they can either hodl it and look forward to the gains from doing so, or they can try to use it as a medium of exchange, which means spending it. So Bitcoin can't be both things. It's either going to remain a popular investment asset or it's going to have some capacity to become money. But as long as it's perceived as being a great investment, people are not going to want to spend it. They're going to want to keep it. And so far, that's what most of them are doing. Okay, questions?
Thank you very much.